Um, Welcome to the first economics tutorial. So in this video, we're going to start off by discussing the structure of the exam. So the exam is divided into two papers, which is paper 1 and paper 2. They are both for 150 marks and 90 minutes each. So for paper 1, there are 8 topics, which are circular flow, business cycle, public sector, foreign exchange market, protectionism, which I believe, the first 5, I believe that you have covered in your June exam. The additional ones are growth and development, industrial development policies, and economic and social performance indicators. Paper 2 consists of 6 topics, and you have covered the first 3, which is perfect markets, imperfect market, and market failures in your June exam. So the additional topics are inflation, tourism, and environmental sustainability. So the structure of exam, the exam has 3 sections, section A, B, and C. Section A is compulsory and consists of a multiple choice question, match the column, identify the concept. Section B has 3 questions and you have to choose 2. Section C consists of 2 essay questions and you have to choose 1. Moving on to the first topic of the day, which is economic growth and development. So most learners confuse the two. So the difference between the two is that economic growth is an increase in a country's real GDP, which is real GDP is the value of goods and services produced within a country, within the borders of a country in a year or given period. So economic development is an increase in a country's real gross domestic product per capita, real GDP per capita, which is the measurement of the total economic output of a country divided by the number of people. So economic growth is measured by the increase in the production of goods and services over time, whereas economic development is a process that concentrates on people's standard of living, self-respect, and freedom of choice. So for development to occur, there should be growth. So there are 2 approaches, which is demand side approach and the supply side approach. The demand side approach includes changes in monetary and fiscal policies with the aim of changing aggregate demand. The monetary policy is controlled or driven by the South African Reserve Bank and aims to stabilize prices by managing inflation. The current inflation target is between 3 and 6%. The fiscal policy is driven by the Department of Finance, which aims to facilitate the government political and economic objectives. So the South African approach uses both monetary and fiscal measures to influence aggregate demand in the economy. So the monetary policy, as I've mentioned, is driven by the South African Reserve Bank. South African Reserve Bank is the central bank in South Africa and it formulates the monetary policy. They make use of the following instruments: interest rate changes. This is used to influence credit creation by making credit more expensive or cheaper. So the rate that the South African Reserve Bank charges to the banks or commercial banks is called the repo rate, and the rate that the bank charges to people is called the prime rate. So if the South African Reserve Bank charge more, increase the interest rate, it means that the banks will also have to increase their interest rates, which will make the credit more expensive, therefore decrease demand in which will decrease demand of loan. So if the South African bank reduces reduces the repo rate, the bank will also reduce the prime rate, which will make loan cheaper, therefore increase the demand of loan. So if South African Reserve Bank wants to stimulate growth in the economy, they make use of the repo rate and the prime rate. Open market transactions. To restrict the credit, South African Reserve Bank sells the securities to the bank. Therefore, this will result in bank having less money to lend, as having less money to borrow people, and cannot extend as much credit as before. So it limits the credit creation. To encourage credit creation, the South African Reserve Bank buys securities, which will result in banks having more money to extend credit. Moral suasion. This is a case whereby the South African Reserve Bank consults with banks to act in a responsible manner based on the prevailing economic conditions. And the last one, cash reserve requirement. Banks are required to hold a certain minimum of cash in reserve in the central bank. So banks have a limited amount to give out as credit. Number two, they also make use of the fiscal policy. South African fiscal policy is put into practice through budgetary processes. The main purpose of fiscal policy is to stimulate macroeconomic growth and employment and ensure redistribution of land. Three main components can be the government spending, taxes, are they two? Yeah. Government spending, taxes. Yeah, let's continue. So they make use of the following instruments: progressive personal income tax, which means that the higher you earn, the higher the tax you pay. These taxes are used to finance social development. The poor people benefit more than those with higher incomes. With this one, the government are trying to reduce the state whereby the rich keep getting richer and the poorer keep getting poorer. Wealth taxes. Properties are levied or taxed according to their market value. Transfer duties are paid when properties are bought. Securities are taxed when traded. Capital gain tax is levied on gains on the sale of capital goods. Estate duties are paid on the estate of the deceased. These taxes are used to finance development expenditures, which also benefit the poor more often. Cash benefits. Cash benefits are old age pensions, disability grants, child support, unemployment insurance, and also the recent one, which is the unemployment grant, are cash grants, and they are also known as social security. payment. Benefits in a kind. This includes the provision of healthcare, education, school meals, protection, etc. When user fees are charged, low-income earners pay less or nothing. For example, public schools, public clinics, public hospitals, and police, and police services. They also provide limited quantities of free electricity and water in those rural areas. Other redistribution. These include public works, for example, the SIP that provides employment subsidies and other cash and financial benefits such as training, financing, and export incentives. The land restitution and the land redistribution. The land restitution is the return of the land to those that have lost it due to discriminatory laws in the past, which is one point that the EFF is fighting for. Land redistribution focuses on land for residential town and production farm for previously disadvantaged group. The money for this program is provided in the main budget. So the land restitution and the land redistribution focuses on those previously disadvantaged groups that were affected due to the past laws, apartheid laws. Subsidies on properties. It helps people to acquire ownership of fixed residential properties. For example, government's housing subsidy scheme provides funding to all people earning less than 3,500 per month. So moving on to the supply side approach. So the supply side approach focuses on the creation of growth. A supply side approach includes everything that can influence the supply of goods and services with the focus on the economic components, for example, competition and potential output. The government intervention aims to facilitate the smooth operation of the market in order to stimulate growth and development. So the government intervenes the operation of markets to stimulate the growth and development. South African approach. The South African approach aims at improving effectiveness and efficiency of the market. This requires markets to operate more equitably and inclusively. More blacks must be accommodated in the mainstream economy if it is to work efficiently. This relates to that BBEE. Business efficiency. Taxes must be collected efficiently. Capital formation must increase. Human resources must be supported to improve, and free advisory services must be available so that business efficiency improves. The cost of doing business must be lowered to increase production. The cost of transport, communication, and energy cost must decrease so that to stimulate or increase production. Thank you.